Hello dear student, I am Assistant Professor Dr. Sony Kashyap from Sarath College of Arts, Commerce and Science. Today we will discuss the topic accounting for price level changes. Let's understand introduction. Definition of price level changes. Accounting traditionally follows the historical cost concept which records assets and liabilities at their original cost. However, in times of inflation or deflation, the purchasing powers of money changes, causing distortions in financial statements. Hence, price level accounting aims to adjust financial data to reflect changes in the general price level and provide more realistic financial information. Price level, the average of current price of goods and services in an economy over a period. Price level changes refers to the variation in the general price index due to inflation or deflations. In accounting, price level changes mean the impact of inflation or deflation on the value of money and consequently on the measurement of income, expenses, assets and liabilities. For example, rupees 1 lakh in 2010 is not equivalent in purchasing power to rupees 1 lakh in 2025 due to inflation. Now let's understand importance in accounting and financial reporting. Historical cost accounting ignores changes in purchasing power. Financial statements prepared without adjustment may mislead investors and management. Ensures comparability of results across periods, helps maintain capital in their terms, not just nominal terms. Useful for policy decisions, pricing, dividend declaration, and performance evaluation. Now let's understand need for accounting for price level changes. There are some limitations of historical cost accounting. Let's understand ignores the effect of inflation and deflation, overstates profits during inflation as expenses are based on old cost, undervalues fixed assets and shows lower depreciation, misleads investors about the firm's true profitability and solvency. Let's understand impact of inflation on financial statements. There are some impacts of inflation like assets, depreciation, profits, liabilities. Let's understand. Assets shown at outdated value, depreciation based on historical cost, profits appear inflated, liabilities appear lower in real times. Let's understand objectives of accounting for price level changes. There are three main objectives of accounting for price level changes. First one, reflecting true profit. Second one is presenting correct financial position. Third one is adjusting assets and liability value. Let's understand one by one. Reflecting true profit. Profit should be measured in terms of real purchasing power, not nominal currency. Second, presenting correct financial position. Assets and liabilities must be shown at values adjusted for current price levels. Now let's understand adjusting asset and liability values. Ensure that depreciation, inventory and capital are maintained in real terms, avoiding erosion of capital due to inflation. Now let's move to the method of accounting for price level changes. There are three methods. First one is CPP, current purchasing power method. Second one is CA, current cost accounting method. Third one is replacement cost accounting method. Now let's understand one by one. CPP method adjusts all items using a general price index. Historical figures are converted into current price purchasing power units. Focus on maintaining the purchasing power of capital. Does not change the historical cost of assets but adjust all figures for inflation. Now we can see the formulas of CPP method. Uh, Adjusted value. How we can calculate adjusted value for CPP method? Adjusted value equal to historical cost multiply with current price index CPI divide by base year index BYI. Now let's understand CCA method. Assets are shown at their current replacement cost rather than historical cost. Depreciation and cost of goods sold are charged on the basis of current cost. Profit reflects the ability of the business to maintain its operating capacity, more relevant for decision making than CPP method. Now let's understand replacement cost accounting. Similar to CCA but focus on replacing fixed assets at their current cost. Helps determine the funds acquired for assets replacement commonly used in capital intensive industries like manufacturing and utilities. Now let's move to the next slide. Advantages of price level accounting. Now let's understand. There are some benefits of price level accounting as well as challenges and limitation. Let's understand benefits of price level accounting. Presents realistic financial statements, shows true profitability after adjusting for inflation, prevents overstatement of profit and erosions of capital, ensures adequate provision for depreciation and asset replacement, improves comparability between different accounting period, enhance decision making for management and investors. Now let's understand challenges and limitation of price level accounting. It is a complex to understand and implement, acquires reliable to consistent price indices, valuation of assets and at current cost involves subjectivity, not yet universally accepted or mandated. Frequent price changes make adjustments. uh, Comparability across firm using different method becomes difficult. Now let's move to the next slide, that is practical application and examples. Real world use cases. Countries with high inflation like Brazil, Argentina often adopt inflation accounting. Public utilities and capital intensive industries use replacement cost accounting to maintain capital. Oil and gas, energy, and manufacturing companies adjust for price level changes in internal reporting. Companies or industries using price level accounting. Like example, if machinery purchased in 2015 at rupees 1 lakh has a replacement cost of rupees 18 lakh in 2025, depreciation and book value should be adjusted to reflect the current cost for accurate performance measurement. Now, I'm concluding this topic. Accounting for price level changes leads to more transparent and informative financial reporting, safeguarding stakeholders' interests during periods of monetary instability. It is a vital accounting practice for maintaining the relevance and reliability of financial information in an inflationary environment. Thank you.